So, welcome everyone. I want to take a second to introduce myself and our panelists, and then we'll do a short overview of what we're going to talk about this afternoon and go from there. So, I'm going to let them introduce themselves in a little bit longer fashion so that they can tell you a bit about their organizations. But as we get started, immediately on my left is Dr. John Fitzgerald. He's with IU Health. And next to him is Lisa Havens. She is with Baylor Scott & White Health. And then lastly, we have Mark Troutman, who is with Summit Re. So what we want to talk about today is to give a bit of the lay of the land on population health, hear about our panelists' experiences with it in their captives, to identify some of the new and emerging risks that we see coming out of population health, and to talk a bit about pricing the risk, underwriting the risk, and also opportunities for mitigation. And I think one of the things that I've been thinking about is sort of every year for the last 10 years, I say this is going to be the year where we see the bridge between population health risk and captives, because they seem like a natural marriage. And so every year I say that, and every year I think I'm proven wrong. I guess this is sort of like the hard market thing, right? We're all predicting that. And it's the same thing for me with population health. And so a lot of the discussions that we've had is sort of, how do we get to that point? What are the pros and cons of it? What are the challenges we've seen in marrying my captive world with a population health world? And I think those are some of the things we want to talk about today. So I'm going to start with Lisa, and she's going to tell us a bit about her background and where she comes from with Baylor Scott & White Health, and I think that'll help inform us as we move forward. So go ahead, Lisa.
Thank you. It's an honor to be here, and I'm with Baylor Scott & White Healthcare System based out of Texas, and there was a merger in 2013 between Baylor Healthcare System and Scott & White Healthcare System. Both were 100-plus year organizations. So I'll share a little bit of information about them. Baylor had the Baylor Quality Alliance, which was an ACO. Scott & White had a health plan, and we'll talk a little bit about how those have come together on our managed care population health initiatives. We were clinically integrated and had some strategic joint venture partnerships as well between the two organizations. But at this time, we have 48 hospitals, all in Texas, that we own or manage or majority own, and over 1,000 clinic access points. We have 5.8 million visits annually, and of our 9,600 affiliated physicians, we have 2,100 employed physicians, about 700 residents and interns, and then about 600 advanced practice providers, and over 5,000 licensed beds. We cover 45 counties. We have approximately 48,000 employees, and we have about 549,000 covered lives in our programs. And total operating revenue, just to give you some information, is $8.4 billion. So it's been an interesting journey, and we'll talk a little bit about that more in a moment.
That's great. Thank you. Dr. Fitzgerald, do you want to tell us a little bit about IU Health?
Sure. My name's John Fitzgerald. I'm a practicing physician, but I've recently assumed a new position within IU Health as Senior Vice President for Population Health for the system. The system is about a $6 billion integrated health system. It's an academic health system affiliated with Indiana University School of Medicine, which is the largest in terms of enrollment medical school, allopathic medical school in the country. The health system has about 16 hospitals now, about 3,000 employed physicians, several thousand affiliated physicians on the medical staff. The employed physicians practice in approximately 300 different locations. We conduct over 1,500 clinical trials in a given year, and provide in excess of $500 million in community benefit. We also have a bit over 200,000 covered lives for whom we take full financial risk, or in the case of our next generation ACO, a nearly full financial risk. and that's a snapshot of the IU Health system. We bear risk through really 5 main entities, 2 health plans, Indiana University Health Plan, which provides employer-based coverage for employers within central Indiana, but also individual and family plans. We also have IU Health Plans not-for-profit, which contains our Medicare Advantage program, an ACO, as I mentioned, that contracts in the Next Generation ACO program, but also is responsible for managing fully capitated global risk Medicaid lives. We have a captive domiciled here in the Cayman Islands that offers property, D&O, workers' comp, cyber liability, provides a reinsurance for professional liability and general liability that our risk retention group, which is domiciled in South Carolina, provides for our physicians' hospital and hospitals.
Thank you. So Mark comes to us from a little different perspective, and I think one that's very informative for those of us more on the provider side or the healthcare side of the world. Mark's with Summit Re, and Mark, why don't you tell us about Summit Re and a bit of your background there?
I come with a different perspective, but actually from the same state. So as an actuary, I should have figured out the odds on having 2 panelists from Indiana. Summit Re is a full-service managing underwriter. We were created when Lincoln National Corporation got out of the accident and health business back in 1999. And that's how I found myself in Fort Wayne, except for the fact that I was actually born and raised there. We have regional offices in a variety of places, but there are home offices in Fort Wayne. All the other offices are in people's homes. 44 employees, basically working across a variety of risk takers, trying to provide them with insurance or reinsurance protection. It could be health plans as an HMO or an ACO or a provider group, or an insurance carrier, a Blue Cross plan, or a self-funded employer. And that makes us active in all lines of business, commercial, Medicare and Medicaid payers. And currently we underwrite on behalf for the managed care business for Zurich American Insurance Company for the last 3 years. Before that, we worked with Swiss Re and ERC. And the employer stop loss is written with my parent, Companion Life, which is also owned by Blue Cross and Blue Shield of South Carolina.
Okay, thank you. So when we were having conversations about population health, Dr. Fitzgerald was kind enough to share some of the goals that IU Health is looking at and some of the competencies that are there. And as we were discussing this, he brought up a number of risks that I really hadn't been thinking about. We all think of population health risk as really sort of the financial risk, you know, that the amount you're collecting for premium for medical claims is not sufficient to pay those claims. So that's sort of an easy one. But Dr. Fitzgerald was really talking to me about a number of the other risks that arise. And so I'd like you to elaborate on those if you can, John.
Sure. So IU Health has been in the population health management business for 20 or 30 years even, taking global risk on various populations of patients. And we really feel that when done right, it's a roadmap to really the quadruple aim. Better care and better outcomes for patients, improved experience, lower costs, and a better workforce, or a better work environment for our providers. And so if done right, can actually lower risks for health systems. However, it requires certain key competencies that correspond to some of the requirements of navigating this area. You know, the first is having analytics that will identify health risks for individuals, stratify those individuals, analytics that will identify at the point of care the gaps in care and allow providers to address those gaps in care. The mantra is providing care in the lowest cost setting. These may be non-traditional settings, so what previously was done in a hospital setting now may be done, as we've heard in a number of sessions, remotely, at home, in retail locations, in places that historically we've not provided care in the past. There's outreach. We don't wait for patients to come in the door. We have to go out and identify them and work with them. So it requires travel. on the part of some of our personnel that they've not done before and are exposed to various risks associated with that. And then there's care redesign. This takes a village, and it takes input from a variety of people, professionals, whose job content may have changed compared to what is delivered in a volume-based setting. Pushing people to the making sure they maximize their abilities within the context of their license. It means new programs. It means new technology as we try and monitor people at home or from at remote locations. And then also we're responsible for the full continuum of care. It's not just the care that we provide in the hospital or in the physician's office. It's wherever they are, it's our responsibility. And thus, with those competencies come several risks that may be new or may be heightened risks from what we know. Julie's already mentioned inadequate premium and relative to costs and some of that, and then there's catastrophic cases and stop loss associated with those. But with new technology, I think we've heard, whether it be telehealth or some of the wearables or implantables, data errors that may occur leading to poor decisions, privacy issues, security issues with those data, and theoretically, the possibility of patient harm from some of this new technology. One approach to providing care in the full continuum is to make it yourself. A more cost-effective approach or efficient approach may be, though, partnerships with other providers. And so are you subject to vicarious liability because of relationships with these partners and the responsibility being the health system? Great emphasis on appropriate credentialing and the due diligence as you assemble the network, making sure that you have the best network possible. And with all those partnerships comes a number of contracts that would require diligence and monitoring. Mentioned some of the new environments. So there's safety, there's new functions, there's travel, there's more auto exposure. There's management practices now, errors and omissions. Lots of times the population health processes involve prior authorizations or claims adjudication, and decisions made on those could be subject to challenge. And then there's some regulatory issues that we confront. If your network is broad and exclusive, or is there some anti-competitive aspects to it? Is there a need for license if you don't have an actual health plan? The whole issue of, do you have adequate reserves if you're not a health plan and subject to some of the state insurance laws? So those are just some of the things that we try and address or are confronted with as we go down this journey.
So this all scared me, frankly. I don't know how you feel about it, but identifying all these new risks made me a little nervous. So I like to turn to Mark, who keeps us grounded, an actuary, right? He's logical, he's focused on these things. But one of the questions I have with respect to my captives is, how do we actually price this risk? I mean, these are the ancillary risks, and some of these risks are going to be covered under different policies, not necessarily under a true population health policy. They're going to arise within the organization. But when we get to the pure population health risk, how do we price it, and how do the captives learn on this? So, Mark, I'll turn it over to you for that.
First, let's just give them some more risks to actually be worried about.
Oh, no.
There are at least a handful from an actuarial perspective. There's, as you said, the ability to get the price right, or adverse selection. Many of the managed care programs in the Affordable Care Act do have adverse selection. Any actuary could have predicted that. There's the issue of uneven enrollment or attribution issues on the enrollment that you do get. There's the risk adjustment process, which I'm kind of surprised of as an actuary. It seemed to make sense in terms of whoever's going to get the worst risks should have a risk adjustment for that. But in the end, what you saw happening is 9 out of 10 parties were saying, I've got a receivable coming. And when you see that happening, you realize many of them are going to be wrong, and they're going to be paying when they thought they were receiving. There's the whole filing and approval process for rates the first time and the second time, whether the rates are right, whether you get the bid right, whether you actually get the bid, those types of things. There was the issue of the cost-sharing reductions in the 3 Rs and the reinsurance and risk protection. And some of those cost-sharing reductions weren't really there, and there's still uncertainty in the future regarding those as well. But I think one of the real key issues is the strength of your network contracts, because if you're assuming management for a population, it's presumed that you know how you're going to manage that, and that you've got good provider agreements and good fee schedules for that. Speaking of the contract risk itself, in terms of the contract where you are assuming the risk for that population, there are some issues there as well, and I wouldn't necessarily say they're all actuarial, but there are some things which someone should take into consideration, such as the contract risk itself. Do the contract structures and targets sufficiently represent the costs required to provide the outlined services for the covered population? And do they provide adequate protection against variables impacting costs that are outside the health system's control? There's the performance risk. Does the system, are they able to achieve targeted quality metrics, clinical efficiencies, and cost controls that are included in the contract, which affect their reimbursement? There's the insurance risk we talked about for small claims and large claims. And then there's the ability to implement and administer the entire program as well. So the programs are fraught with risks, but obviously many parties have figured out ways to manage those. You want me to talk about how one would price this type of risk?
Yeah.
Okay. As fate would have it, it's an actuarial task. If a program has experience, whether or not it's the same program or not, you can obviously try to take that into consideration. If not, you are going to have to rely upon a manual, and many companies have manuals. Actuarial consulting firms or reinsurers can actually help you set prices as well, assuming that they're going to get some layer of that risk. If you have the advantage of a program which has both experience and a manual, then you have to, once again, consult the actuaries or the statisticians and figure out how much you're going to rely upon the experience and how much on the manual. Even in considering how much you're going to rely upon the experience, the question is which years? The last year, 2 years ago, 3 years ago? How do you blend and trend those things? Because all those costs are in the past, and you've got to blend and trend those amongst the years and actually inflate the costs to make them appropriate for what's taking place in the future. So, I mean, those are certainly some considerations. What we've done is we've been in the business for 20 years and basically use all the quotes that we do, the 150 quotes, and so we actually, once a year, off the main business cycle, create and recreate our actuarial manual to update that, so that we can actually give excess of loss pricing by layer. I think the key in any sort of reinsurance, although the client always decides what they'd like to buy, the key is, from our perspective, we would like them to consider something that is in the range of random and unpredictable, neither too many claims nor too few claims, as Goldilocks would say, but just the right amount. So how many is that? I mean, typically that may be 5 to 15. If you've got more claims than that, you're starting to trade dollars, and it actually becomes a normal distribution, and you wouldn't necessarily, it would be more predictable. If you've got too few, maybe you're taking on too much risk. So somebody's going to help you take a look at that. One of the things that I try to do in assisting a client is tell them what other companies have done in similar situations. A simple example would be deductible divided by member months. That's your exposure divided by your actual population. And the larger that number gets, the more risk you are taking, the smaller that number gets, the more risk averse you are. And so we can show you on similarly situated plans by size, geography, whatever, what other companies are doing. But at the end of the day, it still relies upon you and your risk appetite for this given program.
So I'm going to ask Dr. Fitzgerald something I've been wondering, which is, do any of the programs out there, are they really going to reduce that risk? I mean, when I think of our captives that have had professional liability risk, we knew early on there was some low-hanging fruit to mitigate that risk. We could reduce claims costs by really concentrating on the claims handling process. We could then turn to quality. There were things that could be done. What about in the population health space? I mean, you're handling that risk at IU Health, not yet in your captive, but what are you doing, and do you think those things are effective?
Yeah, so the most important thing we believe are sort of the risk management operations that you have in place. The use of the captive can help with the financing, but you really need to focus on the processes. And so there's a number of interventions that are very effective, that whether it's trying to engage patients better in self-management. As you know, most of the costs of chronic diseases are related to lifestyle choices, smoking, diet, activity, adherence to medications. And there are a number of programs that can be effective, but you need patients engaged, and patients' levels of engagement are related to how activated they are. And if you take a population of patients, you're going to find a variation in degrees of activation. And so some interventions should target those that are highly activated, and actually it's quite easy. Other interventions would be futile if targeted at the wrong level of activation. I think programs that address transitions in care, especially transitions out of the hospital, have been shown to be very effective. And probably one of the most effective interventions. So there are a number of interventions that are used in trying to manage these populations and manage the health of their populations that can be effective. But again, it often comes down to what kind of analytics do you have available, what kind of reporting is available. We think another really important aspect is looking on the provider side. So our providers have strong incentives to close gaps of care, to address quality issues, to address transitions. And so that's also added motivation and added effectiveness for some of our risk management efforts.
So now we're all scared more by some of this population health risk. But let's turn our attention now to captives and how captives might participate, what models might be out there. I find when I say population health that everybody just immediately thinks stop loss. And so that is obviously one form. But there are other forms of population health, and there are other ways that captives can participate in that. Some of them are listed up here. Lisa's had a really interesting experience based out of a need that the healthcare system has. So I'd like her to describe how her captive is being used with BQA, which is their ACO.
Sure. Well, I think one of the first parts of this journey was for us from an enterprise risk management perspective is getting to know our ACO and understanding who they were, what they were about, and what were their boundaries and parameters of what they were doing, as well as the health plan and how those two may partner and work together and what would make sense. So our BQA, our ACO, they had already had in place customized programs based on their population, what the contract was, what the interventions were that were needed, and what the physician state of operations were. So those were customized. And then they also clearly, obviously, focused on personalizing it for the patients and looking at what was the disease states, what's their utilization rates, what are the goals, what is the demographic, socioeconomic status, et cetera. And then both the Quality Alliance and the health plan got together and came up with some joint vision, joint goals, and looking at within the boundaries and parameters of what they could do together, how are they going to align and do that with our fully integrated model that we had in place. The ACO already had in place clinical protocols, care coordination, performance accountability, a lot of data analytics, and really a lot of transparency to our providers and accountability. Were they complying with those clinical guidelines? What was their data like, and how did they compare to others as well? Then they also were very involved with their 4,800 physician members across the continuum of care and looking at some key strategies, which included the medical-centered home, patient engagement, like you mentioned, comprehensive care management, and then also looking at the physician engagement piece as well, because both of those are essential in our mind for these to be successful in looking at the data that we had internally. All that became important as we had a captive here in the Caymans we've had since the late 80s, and is now a SPC, and a very robust captive, fully integrated, many, many lines of insurance through there. So we had the experience of taking on new and different kind of risk and been successful at that. So we were approached by the BQA or ACO about a new risk that they were undertaking to see if we as the captive could help them in that journey and looking at that. And so that was a new experience for us internally. It was a new experience for some of our advisors, and it was a new experience between different areas, whether it was finance or risk or insurance or the BQA. We realized at some point we were all speaking a little bit different language when we talked about risk. So it took some time to really work through that process together. And what they were approached with is they had a commercial ACO contract that had 30,000 projected members in it with a risk-sharing agreement that included savings as well as downside risk. And this is our first one with the downside risk in the ACO. And the downside risk was made up of split between the commercial payor and the ACO, and then the ACO portion was split between the ACO, the hospitals, 12 hospitals are participating in this ACO, and over 4,000 doctors. So the issue came up with the regulatory restraints. You know, a lot of these were not employed physicians or independent. They had to share genuinely in that risk if they were going to be part of that. So we look at if we had a downside risk that required payment, how logical is it we're going to go around and collect from over 4,000 physicians their portion of that? What is the right approach to that? And we can't pay it for them. So we looked at, should we insure that portion? Do we insure the whole downside risk with the BQA and the health system and the hospitals and the physicians? And how do we approach that? So we looked at all of that and really got narrowed down on we wanted to insure the physician part of that risk. We knew by looking at the contract what the limits and parameters, what the maximum exposure was for that risk. And we looked at, we got quotes for premiums and buying insurance to do that. We looked at the captive, we looked at what our deductibles, is there a hybrid approach in doing that? And one of the things that took some time, someone mentioned earlier, is really getting the data. Not only the contract and what are the terms of the contract, but what's the loss experience, what are the benefits, what is it we're agreeing to do, and how we manage that. We also had to get the actuaries involved and get them data that they could look at and help price this, comparing that to what other quotes we were getting. We had to do a lot of work internally with our leadership and really educating and bringing everybody along on what is this risk, what's going to make sense, and then meetings with our captive board to let them know what we were looking at, get their questions, concerns, because this was a journey to come back with how we would do that. And then also when you look at these contracts, it's important to look at, when does that risk begin? Because a lot of these contracts you start today, but you may not be risk-bearing on the downside till year 2 or year 3, so, looking at that. And then also working through SEMA approval. And we did end up with providing coverage in the captive for that physician downside risk. We were able to, again, estimate that maximum exposure and look at the actuaries and put a policy in place that was based on a 1-year risk period. And we did price it based on per member per month. We had a target rate and a target deductible and a maximum amount of insurance. And again, all those were priced on per member per month, and a deposit and minimum premium, and it was all auditable. So at the end of the year, we ended up with more members than expected, so all of those rates and premiums were adjusted. It's been good so far. It's fairly new in navigating through all that. So that's what we've done.
So, I know meeting with my clients, everyone's asking, who's doing what? Is anyone doing anything? Everybody thinks everybody else is doing something, but really a lot of this stuff is pretty new. It's pretty cutting edge, And, you know, organizations like Lisa's are kind of putting their toe in the water as they start to learn this and learning lessons about how to do it a little better next time, or at least more efficiently and easier next time. So Mark, you've had probably more experience than all of us in structuring different kinds of programs. I know you've done some group programs. My clients and yours have participated in some reinsurance programs. Why don't you tell us about those?
Sure. I think we got a slide on, 2 slides on this, right?
Yep, okay.
First, I just want to talk about a typical reinsurance structure. I think the other
Next
slide
one?
first. yeah.
Okay.
Typical reinsurance structures, quota share excess of loss. There we go, okay.
Oh, that one, okay.
Yep,
That one.
that's it. These are really the options to consider for reinsurance. The quota share, the primary motivation there is capital and transfer of risk on a proportionate basis of all premiums and claims. So essentially, the quota share that you choose dilutes your premium and your claims by an equal amount. All small claims, all large claims. So typically, a company who wants to take risk but doesn't see itself taking all the risk might take a 50-50 quota share, or 80-20, 80% to the reinsurer even. They still maintain responsibility for all the actual management of the care of the population. It's just that the actual risk of the claims is transferred via this quota share. So if a claim occurs and you've got a 30% quota share, then you're paying 30% of that, the reinsurer is paying 70%. Excessive loss is different, that's non-proportional. The motivation there is to primarily protect you against really severe catastrophic claims. So you transfer that claim volatility, and how you do that is you actually select a deductible level where you're responsible for everything below that, and the reinsurer is responsible for everything above that. So if the claims are small, your proportion is all of it. If the claims are very large, your proportion is whatever retention that you've chosen. And so those various layers are priced, as we've talked about today, based upon actuarial manuals and frequency and severity of claims. What you see typically happen in the market, given that the Affordable Care Act has basically made many coverages, liabilities unlimited, they're priced the same way you see reinsurance layers on other coverages, 1x1, 3x2, 5x5, and then, as we call it, Infinity X10, because you actually have unlimited risk. So, but there are plenty of markets out there willing to take risk above $10 million, and I'm sorry to say there are plenty of claims above $10 million in the medical excess of loss market. The last option is really aggregate stop loss. You might do that if you've been involved in employer stop loss. You see that because you know that many of those plans have not only a specific deductible, but an aggregate limit as well. In this situation, you might be doing an aggregate on your entire portfolio. Let's say you were a next-gen ACO, and you've got a very large risk for a very new and unknown population, and maybe you sleep at night, but maybe some of the other people in the executive suite don't sleep as well. And so what they might like you to acquire is some sort of coverage that kicks in at 105% of expected, and then takes some layer of risk up to, say, 115, at which point it then reverts back to you. In a more traditional mold, it might be a 125. You're responsible for all risk on all utilization on this entire population up to 125% of expected. And obviously, the higher corridor that you take, the lower the risk charge, because you're just playing with an actuarial tail on probabilities, okay? So those are the options. In terms of types of deals that we've structured, I'm just going to briefly describe 2. The first is, we actually have a diagram for, and it may look complicated, but it's really not that bad. What you have down in the bottom left corner is a cedent. It's a health plan. It's an HMO. They had several lines of coverage. We used to reinsure them on a conventional basis. We took all the premium and paid all the claims. But then the second line of business came in on an acquisition that they had, and they said, we'd like to use this captive that we have. So we said, okay, let's structure a deal to actually accomplish that. So you've got the cedent on the left. Over on the right, bottom right, you've got the captive, and that was already established, and it was being used for a variety of other lines of business. So how did we get a conduit company in the middle, and what do they do? This particular entity happened to have a professional insurance company that was providing coverages as well, and so they wanted to give them a slice of the action and involve them in the transaction as well. So essentially what happens is the cedent chooses a deductible of $500,000, for which they're responsible for all claims below that, and then they cede all claims above that on the excess of loss, non-proportional basis to the reinsurer. The reinsurer in their eyes is the conduit company. It happens to be a domestic company, which was licensed and gave them the proper reserve credit they needed rather than have to focus on letters of credit or assets in trust or anything like that. And so that particular company kept 25% of the risk and then ceded the other 75 to the captive. And that particular company kept a fee for their administrative purposes as well. That's all good and well, but the company decided that they didn't want to be responsible for very large claims, and so we offered them options at $2, $3, and $4 million, and they selected one, and that was provided by the reinsurer on whose behalf we underwrite. And so although these companies have quota shares retained, they actually are being bought out on an excess layer. Now that particular layer could be $3 million from the ground up, or it could be $3 million from their retention. It's their choice, and obviously it's just going to affect the actual layer of the claim and the pricing that's involved there. And then what we do is the administrator of the program actually we're acting as a managing underwriter for two companies there, the company in the middle and the reinsurer, and we set the rates, collect the premiums, pay the claims, help them manage the care, and then provide reporting that says, you have to pay this person this, so on and so forth to make the transaction work. The conduit company in this situation, it was easy for them to be in the middle because it was a reinsurance coverage. If it was an insurance coverage and you didn't feel you had the ability to assign it because you were a related party, then you had to find issuing carrier paper, and that's where the reinsurer would actually just step down from that corner and put themselves in the middle of that transaction and offer, as an example, a provider excess policy. So that's that's a typical deal structure that we certainly like and hope there's more of in the future. The second transaction is just a group captive, and it involves employer stop loss. If any of your entities are writing employer stop loss, along with other fully insured coverages to self-funded employers, utilizing their strong managed care networks and your strong managed care networks and medical management capabilities, somebody may have the same desire to be in a captive, but don't have a captive because they're a single employer. And so each employer would essentially buy their own employer stop-loss policy, set up their own plan document, and in this situation, with this Cayman captive that we're working with, the employers have choices between $25,000 and $150,000 of their self-funded deductible. The rest goes into a captive. In excess of $400,000, a reinsurer once again comes in and picks up that risk so that the captive is only responsible for all claims below $400,000. Now, there's two other risks that are actually involved there. When you write an employer stop loss, you have the aggregate cover, which covers the employer for 125% of their expected claims below the attachment points. And so in any situation that we work, the reinsurer typically gives that company the option. Do you want that risk or don't you? It's a low-frequency, low-premium cover. Sometimes they like it because it allows them to actually set the attachment points for their self-funded employers and then take the risk for that. The third level of risk is the captive is still exposed for adverse experience on that retention it has on all the programs between the self-insured retention and the $400,000 limit. So this reinsurer actually also provides them an aggregate cover on that says your experience as a captive organization will never get worse than 125% of the stop-loss premiums that you're charging to that group. So that allowed them to sleep better at night as well. I think the other advantage of the program is that it required each of these employers to select a common network, common TPA, get involved in wellness programs and governance, because anyone who's involved in a captive knows it's not an easy in, easy out transaction. So they had to be committed to managing populations for the long run.
So we know that those structures are out there. We know that they're being done. What do you see, John and Lisa, from the perspective of a system bearing risk, provider risk, and B, an employer bearing stop-loss risk? What do you see as the challenges between having that risk and getting it into the captive? John, why don't I start with you?
Sure. I think our biggest barrier that we've faced is sort of the unfamiliarity with the other aspect. So population health folks aren't familiar with captives and don't understand how they work. And Similarly, the captive folks in our system at times have not been very familiar with population health and are uncertain, do they have the internal capacity and capabilities to appropriately manage it, because the captive certainly doesn't. So that's really been our biggest hurdle to try and get the two together.
Lisa, you mentioned information. Other things that you saw as hurdles as we were trying to bridge this gap?
I think I would echo what you just said. It was just a new experience in educating and learning together and trying to get all the right parties on the same page and to a comfort level, and then just continuing to monitor and look at that risk.
So Mark, you're the actuary, so I'm going to let you make the prediction. Is this going to happen?
Well, I remember writing an article about 8 years ago, or 9, when the Affordable Care Act was just starting, and the ACO concept was first introduced. And the article said, you know, ACO, panacea or placebo? And the answer is neither. But I was trying in the article to draw out reasons why I thought this level of risk-taking by entities accepting population risk would be better than the last time, because I think they're smarter, and they have integrated delivery systems and more electronic health records and data management and better vendors. Because back in 99, 2000, there was a massive transfer, back in the HMO age, in case anybody forgot about that. There was a massive transfer of risks to providers on a capitated basis, and the providers didn't know the risk they were getting, and they didn't manage it very well. And so I think that, I still believe that they'll do a better job this time, but it just takes a ton of time, because saying you're an ACO doesn't make you an ACO, but the actual, or to actually manage care. But if you look at the numbers of ACOs being created, they are just dramatically increasing, and then ultimately they will take risk, or many of them will, and it'll be upside first, or limited upside, and then, you know, upside and downside, and then ultimately, presumably, some more global capitation. Some of the studies that are out there show that there's still a variety of providers. Half of them are interested in value-based medicine, and the other half are not. So the ones that are not are probably not going to go down this route, but the ones who are certainly going to expand the provider excess and health plan reinsurance market over the long haul.
Well, and if we look at for employers and for those owners of captives, health systems that own captives, we look at the benefits that putting medical malpractice, general liability, other liability, workers' comp, other liability coverages have had, both financially for the employers funding those, and then also for, you know, injured employees, injured patients, and others. We look at that enormous impact, and we can see that there's also that correlated benefit here, that if we can figure out how to do this right, it's saving all the employers money, it's saving the systems money, and hopefully improving the health of the population, which is a great goal that we can all get behind here. I think from the captive's perspective, one of the things that I'm thinking about is, as this risk comes in, what do we need to do at the captive level? How do we need to change and adapt? For example, do we need to set up different cells so that this is really looked at and risk is segregated differently? Do we need to change board composition? You know, should there be people with expertise here? Are the right service providers sitting around the table for this, or are there other service providers that need to be added to help the board understand this type of risk as well? So those are the kinds of things I think we still see coming down the road, and we'll see if we're standing here next year, whether they've come to fruition more or not. With that, I know we're running on time here, so I'll open it up if there are any questions from anyone in the audience. Yes.
Two questions. I was wondering, does this apply to Medicare and Medicaid ACOs as well, or just commercial? And my second question, we have a joint venture of about 5 hospitals, and we work together on an ACO, but we are independent. So would we need to insure our own risk? Is that
So the ACO, the Medicare ACO regulations originally had some requirements for financial security that included insurance. They changed that because they said no one was getting that insurance. So there are still some financial responsibility requirements in there for Medicare HMOs. I think the commercial ones are really going to be governed by those commercial contracts and what they say about reinsurance or financial stability and things like that. And then I think your second question was about many organizations joining together in an ACO. Is that correct?
That's correct, but just as an individual health system within that group, why affect myself?
Well, it depends on how those contracts work. I mean, I think that's what we saw in the case of the ACO that Baylor had, was there was risk in these pools, and so every participant in those pools was bearing risk at some level. Yep.
And the hospital and the ACO chose to self-insure that risk. But that's one of the things as we look forward and look at the aggregate risk and additional contracts coming to us, is do we want to do that differently? And
Assuming all those hospitals in that ACO are under Baylor stuff.
yes.
That's correct. Any other questions? Yes.
An example you've shared here, at the first level, there's 75% sharing through the net portal arrangement. In our system, it's a little different. The provider group, which happens to be an ACO, contracts through the captive and the reinsurer, but retains 10% co-insurance risk through the captive way to try to ensure that they have skin in the game in these high-risk cases and don't just wash their hands, so to speak. Do you have any experience, particularly, I guess, from Mark, in terms of what an effective co-insurance percentage might be?
So the question, just for the record, is what a effective co-insurance provision and percentage might be in these types of arrangements.
It's important because with any insurance or reinsurance, you want to make sure that the other entity, even if a catastrophe occurs, still has some economic interest in doing that. I would argue they always have an economic interest because at any point in time, their future experience rate is, their future rate is, somebody's going to take a look at their experience and figure out whether or not they had bad experience or not. But it's not just co-insurance. Although most plans that we reinsure have 10% co-insurance, I certainly like 20% because that means they have a larger economic interest. It's also a function of that deductible. This particular person is taking $500,000 of every claim that's actually out there. Now, at some point, you have to say that they couldn't predict it, they couldn't keep it in network. The question is, can they manage it, or can you bring them resources that will help them manage that? And most reinsurers clearly will help plans. They have no direct responsibility to the plan or their members, but they will try to make sure that you know all the options that are out there in the treatment plans, or help you find vendors who can do that, because ultimately, the more you save, although the reinsurer saves money, ultimately, the reinsured saves money as well, and so it's a partnership in that regard. But clearly, you want to make sure that they have an economic interest through 20% or 10% co-insurance, or a higher deductible.
All right, with that, I think we'll conclude our presentation today. Thank you so much for coming, and enjoy the rest of the sessions.